Hello everybody, this is Rudy for Best Investor. What I thought I would do today is provide a very short and somewhat superficial summary on how to make money in the stock market. So it's going to be something different compared to most of my videos that you've watched by now, which is all on Occidental. If you're an old seasoned pro in terms of trading and investing, you probably don't want to watch this video at all. But if you are new to the stock market, filled with a little bit of trepidation in terms of whether you actually want to get involved in trading stocks or investing in stocks at all, then maybe this will be of benefit to you. So let's go. So the first thing we want to talk about just very briefly are financial advisors or wealth managers. These are people who are generally guaranteed an income because they take fees on AUM, which is assets under management, which simply means your money, and they are typically licensed salespeople. So it's important to realize that financial advisors and wealth managers are salespeople, generally trying to sell you a product or otherwise trying to sell their services, which is the product on which they're going to earn a commission. Being a licensed salesperson, for instance, in the United States, having a Series 7 designation behind your name does not make you an expert. It makes you a licensed salesperson, kind of like a realtor. So the fact that you're a licensed realtor doesn't mean that you're a good realtor or a bad realtor. It just means that you are licensed to sell real estate. So my provisor here is, if you don't know what you're doing, or you feel by emotion and you are scared of trading in the markets, or you don't want to do any homework, then hire a pro. Conversely, if you're willing to do a little homework or are mostly rational and willing to learn, then do it yourself, which is also referred to as self-directed investing. The neat thing about doing it yourself is that you retain 100% of the returns because you're not paying fees to the salesperson who sold you their products or their services. And I added a comment here. I'm saying it's relatively easy for you to outperform the pros because unlike the pros who might be managing 20, 30, or hundreds of accounts, you are managing your own account, which means you will be paying attention to your investments and the performance as you go along. So that's just sort of a little bit of background before I get into the rules that I've set out for you, which are 5 basic rules that you can follow. Before we do that, just typical financial advisory fees, they just sort of generally range from around 1% to 2% or thereabouts. As a breakdown, they are saying that they charge you about 0.5% for financial planning, they charge you about 0.5% for investment management, they charge you about 0.2% of a fee for their platform fees, and another 0.5% or so for their investment product expenses. Now, of course, you can set up an online brokerage account for free, and you can get pretty much all the same stuff that I've just mentioned here at no additional cost, but you'd have to do a little bit of work yourself. So either you pay a pro or you do it yourself. Here's my rule number 1. Learn a little bit of basic math. The first thing that you need to know, which probably once you get to grips with this will stay with you forever, and that is that 15% compounded annual growth will double your investment every 5 years. Now that doesn't sound like a lot, but it actually is very, very significant in terms of compounded investing. If you have $1,000 invested and it doubles every whatever that the frequency is, 1,000 becomes 2,000, 2,000 becomes 4,000, 4,000 becomes 8,000, 8,000 becomes 16,000, and so on. So the compounded growth is actually very significant. You could almost say your targeted return on investment is 15% because that way you know you're going to double your investment every 15 years. But you need to try and understand the concept of compounding. So here is my challenge question to you, for which you need to provide me an answer to in the comments. A pond has a lily pad. Lily pads grow like weeds. They double every day. After 50 days, the pond will be covered with lily pads. On which day was the pond half covered with lily pads? You can provide your answer to me in the comments, and we'll see how we go. This one is easier. You just take your calculator and take 1 penny and double it daily for 30 days. In other words, 30 times. And it will be more money than you could possibly imagine. These are sort of little exercises that you can do to illustrate the value of compounding and the growth that you can actually achieve when compounding starts kicking in. This is the Dow's 30-year chart. So I started here 30 years ago, 1980 to 2020, and this is what the Dow looks like. It has had ups and downs and ups and downs, and your stocks would do pretty much the same thing. These gray bars that you see here is the 2000 dot-com boom bust. This is the 2008-9 financial crisis, and this is the recent coronavirus pandemic. So these gray lines are commensurate with a huge drop in the market. But here's the good news. If you average out the Dow for the past 100 years, the annual return was 7.75%. Without adjusting dividends and inflation from 1920 to 2019. So for a period of almost 100 years, the Dow has generated an average return of 8% per year. Why is this important? Because of rule number 2. When you start to invest, I need you to think of only investing in companies that you know. Well, you may say to yourself, I don't know any companies at all. So that's why I reference the Dow, because if you started with a blue chip listing like the Dow, it is an index of 30 of the largest blue chip US issuers. Issuers is just another word for publicly traded companies. So here's a little snapshot of some Dow companies up at the top here. It's somewhat out of date because I see GE is in there underneath my check mark. But anyway, it's 30 of the largest and most successful companies in the United States. You can almost take the list of Dow stocks from a safety point of view, throw darts at it, and then select a few that you want to invest in. So let's assume this. You have $1,000 to invest. You start off by opening yourself a brokerage account. Then you select 5 issuers from the Dow for an investment of $200 in each. 5 times 200 being $1,000. How do you select those 5? You kind of throw darts at the Dow, and from the 30 stocks you pick 5. What you try to do is avoid similar stocks. So I use the example here saying Microsoft and Intel are both tech stocks. You don't want 2 tech stocks. You want something in financials like, let's say, JP Morgan, one of the tech stocks like, say, Intel, another one that's an industrial or a conglomerate, and another one that's in pharma, etc. So you want 5 different verticals, and instead of parking all your money in one particular type of vertical. You can also look for the ones that pay the highest dividends. So for instance, Microsoft's currently paying 1%, whilst Intel is paying 2.5%. So which one should you pick, Microsoft or Intel? Well, nobody knows because you don't know where the stock's going to go in the future. So at the very least, to provide yourself a little bit of risk mitigation from the get-go, you can say, I'm going to go with the one that pays a higher dividend, which in my example here is Intel. I'm not making a suggestion. I'm just giving you an illustration. Then what you want to do is enroll in a DRIP. A DRIP is a dividend reinvestment plan. So when you get this 2.5%, sorry, it's a little bit obscured under my thumbnail picture there. When you get the 2.5% dividend, it automatically is reinvested for you into more Intel stocks. Now, I just showed you on the previous slide that the Dow is generating approximately 8%. And in this example, Intel is giving you a 2% dividend, so 8 plus 2 is 10, so you're already on a 10% growth for this particular one equity, which in my example is Intel. So you see where I'm going? You're trying to achieve 15%, and in my example here, the Dow is going to give you an average of about 8. Intel might give you a negative. It could also give you a positive. It could go up 20% in 1 year, plus the dividend. Anyway, you're trying to achieve 10 to 15, and this gives you a 10% head start in theory anyway. So let's see the next slide. So this happens to be 10 years of Intel performance. So stock performance from 2011 to 2020 as of today. The stock, like any other stock, goes up and down and up and down and up and down, and this is where we are today. And where did we start? So 10 years ago, Intel was trading at about $25 per share. I know it's small for you to see over here on the right-hand side, but you can see Intel was sort of there in the just above $20 per share. And today, there where I drew the circle just here, Intel is trading at around $50 per share. Referred to rule number one. Rule number one said, at a 15% annual growth per year, you will double your equity investment every 5 years. So in this case, Intel has doubled over 10 years. So it hasn't achieved 15%, it's achieved more along the lines of about 7.5%. One of the reasons why is because in the past year, Intel took a huge drop on a number of occasions, first because of the coronavirus and second because of its last quarter reporting. But it serves the point for the purpose of my illustration. Rule number 3, you need to manage your emotions. And that's a little bit of a balancing act between emotion and logic. You have purchased, using my example, a small ownership in 5 major corporations. Macro events, like for instance the US election, will make your investment volatile and unpredictable. It's scary sometimes. In addition to that, your stocks will go up and go down every single day. Kind of like my check marks, they don't look too good right now. But it will be scary from time to time. When the stock market goes down, you will feel sad. And when it goes up, you will feel happy. Because we're just human beings. That's just the way it is. But you must stick to your plan, which is to remain invested in the companies that you've selected to invest in, at least until you achieve your investment goals, which are what? Only you can answer that. What are you investing for? Are you investing for your retirement? Are you investing to buy a house or a car and pay cash for it? You want to build some real wealth over time? These things are different to earning a salary, which is basically income and expenditures and mostly taxes. Saving money, which will never make anyone wealthy because the interest rate is almost zero, or winning the lottery, and for that you pretty much have no chance at all. Rule number 4, learn some very, very basic principles. If your stocks go up, you will feel good, but you have not made any money until you sell it, which is exiting the position. If your stocks are flat, you are still making money as long as the issuer is paying you a dividend. And if your stocks are down, you have 3 choices. You can either sell your stock, which means you take a loss, and that's a realized loss. Sometimes people sell stock for tax purposes because they want the loss in order to reduce their taxes. For an average small investor, this is not what you want to be doing. When your stocks are down, you do not want to exit the position because you're going to take a realized loss and just lose money. You could also elect to do nothing. Nothing simply means that you stay invested and you wait. And while you wait, quarter after quarter, you will be earning your dividends and everything will be okay, except for the fact that on some days you'll be happy and on other days you'll be sad. Or otherwise, what you could do is you could buy some more. But what you need to do is a little bit of homework because you need to be cautious. There might be a fundamental reason why the stock is going down or why it has been going down. Maybe the company has significant problems, financial problems, like not being able to pay its debt. Maybe there's something else wrong with the company. Maybe their product is no longer in demand because of technology changes or because of changes in patterns of behavior or buyer behavior or consumption. So you need to at least do a little bit of homework and pay attention as to why the stock is going down. If the stock is going down for no particular reason at all, just because it's not the market favorite right now, for example, in other words, emotion or high frequency trading or something else is impacting the stock, but there's nothing fundamentally wrong with the stock. You could say, I'm going to add a little more. And the reason why I say a little is because if you had $1,000 to invest, you don't need to invest $1,000 today because there's no baseball type analogy applicable here where if you swing and you miss, you're going to be out. What you can do is you can say, I have $1,000 to invest, so this month I'm going to buy another $250 worth of this particular stock. Next month I'll pick up another $250, and the month thereafter another $250, and so on, which means you at least are balancing your cost basis as you go. There's no reason ever to jump in boots and all. Rule number 5, and this is my last one. In my example, you do not need 5 winners. In fact, The good news is you literally only need one winner in order for your stock portfolio to be right-sized. So it's very possible to get an outlier that actually gives you an enormous uptick on your portfolio just because one particular stock, one equity, is up 10x or 20x compared to the price that you purchased it at. So for the sake of this example, I've just used 3 different stocks. And I said, hey, remember BlackBerry? Here's a blast from the past, right? Let's say you invested $10,000 in BlackBerry, and after a year it was worth $2,000, and after 3 years it was worth $1,000. Well, here's the good news about equity investing. Your loss is absolutely capped. The maximum amount you can lose is the amount of money that you invested at the start. That's the good news. I know it sounds bad, but it's actually the good news, which means your losses are capped. However, your gains are absolutely uncapped. So in this example, I put $10,000 into BlackBerry and lost almost all my money. But I also put $10,000 into Tesla, and that's worth $75,000 today. As a result, even though I only have 3 stocks and one of them, Coca-Cola, went nowhere for 3 years, in my example, my starting position on my portfolio was $30,000. After 1 year, courtesy Tesla's growth and BlackBerry's crash, my portfolio was worth $62,000. And 1 year later, BlackBerry had gone almost to zero. Coca-Cola still gone nowhere, but Tesla's at $75,000 and my portfolio is worth $86,000. So in this particular example here, I'm illustrating to you that your losses are capped by the amount that you've invested, but your upside or your gains are absolutely 100% uncapped. And if that stock that you invested in, like Intel, which is currently trading at $50, goes to $500, all strength and good luck to you. On the other hand, if $50 goes to zero, all you can lose is $50. You get that? That's rule number 5. So all you need is 1 or 2 stocks in your portfolio to outperform, and your entire portfolio will be right-sized. So there you have it, guys. 5 simple rules that anyone can follow. If you want to start building wealth, this is sort of an introduction as to how you can do it. Investing is not scary, and you will soon be saying, hello, I am an expert. So on that happy note, good luck to you. All strength if you start investing, and if you're doing it for the first time, best of success. Have fun in the meantime too. It's not that scary. And on that note, stay safe, take care. It's Rudy for Best Your Investor, and I will see you next time. Oh, and by the way, please hit the subscribe button. I really appreciate the fact that we can build a community of like-minded investors. Goodbye for now. Take care.